Trader Café. This is a show where we interview people from the world of trading to help learn what motivates them and drives them to succeed with their trading. So during this series, we're going to be talking to traders. This is a show where we interview people from the world of trading to help to try and bring you insights as to how to go about improving your trading edge. Our guest today is Gordon Scott. So Gordon is based in the beautiful state of Utah. So Gordon's focus is mostly on the US markets and equity trading in particular. He's been a trader and an analyst for many years now, and I've been looking forward to speaking with Gordon for some months now since he's joined the team. And folks, look, this interview is slightly different because due to the time zone differences between New Zealand and America and Singapore, this episode is pre-recorded, so there won't be a prize giveaway this time at the end of the show. But as always, we're squeezing some rapid-fire questions at the end, and I'm sure you're going to enjoy this special and America and Singapore. This episode is pre-recorded, so there won't be a prize giveaway this time at the end of the show. So as always, we're squeezing some rapid-fire questions at the end. I guess I'm sure you're going to enjoy this. Can I start asking you by asking you how you got started in trading?
Well,
so as always, we're squeezing some rapid-fire questions at the end.
I guess I've been looking forward to it. As many people who have come to know you might have heard somewhere along the way. Well, we had a common student in Ainsley Club, and I actually managed to, by happenstance, was her first coach, and then you took her to the subsequent high strata where she is now today. And that's been fun to be able to recognize that we both had a hand in some part of her success. Trading is so individual, it's really mostly about the person themselves. My trading career is, I want to start right off by saying I'm of the firm belief that if I can do it, anybody can do it, because I am not the world's, born trader or anything. I have a lot of biases, a lot of personality strikes against me that would make me naturally a poor trader. But I became a good trader over time because I just loved it so much. I wanted to do it. And I was very fortunate to have three things happen all at the same time that launched my experience in trading, and then eventually coaching and writing a book and helping other people learn to trade. I see myself not as a world-class trader, but more as I like to think that I'm a world-class coach. That is to say, I really feel like I can help other people become excellent traders. And I've watched several people who I've coached go on to be, $1-million a year traders. And I'm more happy about that than I am about my own success. Meanwhile, the fact that I have any success at all is also something I'm proud of. I took a survey once, and the survey was specifically about how well you were likely to do in trading. And it was this heavy duty instrument. It was 80 questions or something like that, and they were kind of in depth. And when I got the results back, I noticed that I scored in the 30 percentile, and I thought, oh, that's great. I'm in the top 30 percentile. It took me a month to realize after rereading it that I was actually in the bottom 30 percentile. Meanwhile, that month was consisted of me going out and getting my Series 7 license, FINRA license, so that I could be a broker, and joining up with a proprietary day trading firm and doing that for almost 2 years. And it was really an interesting experience in the sense that at first I thought, oh, I'm born trader, and then getting into it and realizing, wait, no, I'm not. But having a little success, shouldn't that count for something? And so it was a lot of back and forth. But that's I do not come with raw material for good trading. What I do come with is raw passion for the markets, for learning about it, and for recognizing, hey, if I'm going to trade well, I need to be careful. I need to have good risk management, because I'm not just, money's not just going to fall in my lap because I'm that talented. So the three things that happened that got me started into trading go like this. I was out of work uh, because the month was 9/11, or I mean September 2001, and I was in Dallas, Texas at the time, and the tech sector was pretty heavily hit after the 9/11 explosions and so forth, and just it absolutely blew up my career. It was I had been working for IBM for 10 years up to that point, and then I had just left about a year before to join up with a semi-startup company, a small company that provided outsourcing technology services to internet and software companies. So, in that month, our entire customer base just evaporated, and so did the
Yeah.
business, and I was stuck. I remember going to a job fair where there were 10 jobs and 1,500 applicants. And these
Wow.
guys all had suits and degrees, and literally an hour and a half line for the one job that I had even mildly close connection to. And after waiting in it for 45 minutes, I finally came in view of the people that we were all standing in line to see. And those people were already, it was the middle of the day, and they were exhausted. They're just, yeah, thanks. Throw the resume on the pile. We'll call you. Yeah, thanks. We'll call you, And I just thought, oh, man, I, I'm wasting my time here. I went up and threw my resume on the stack, and went home and tried to figure out what on earth am I going to do? How am I going to? At this point, I have 5 children and a big house in Texas because I'd come in this small company at the kind of top end and had a good salary to support everything, and it was all gone. I just thought, wow, what am I going to do? And I got this idea in my head that I should follow my passion, that I should just follow whatever I'm so interested in and so passionate about that it would propel me through whatever difficulty. And so I just tried to sit there and think about, what am I interested in? I was in a library, and what came to mind was the stock market. I am so interested in the stock market. Now, I would never tell anybody this is the way you should decide your career. But given that it was literally a major career change for me, I'm glad I did it this way, because in any other way I would have talked myself out of it. But this, even with all that, I wouldn't really have done it and wouldn't have ended up where I was, except for these 3 things that happened all at the same time. And the first was that because it was 9/11, because I was unemployed, and I was trying to work my finances, I tried to consolidate all my credit cards into either a single card or my mortgage to reduce my monthly payments. And so I was working with this one particular balance that was $800. Not a big deal, but it was just going to be included, and in the clump of whatever I had, and I got this notice back that they had, in fact, as I requested, transferred $8,000 into my account. 8,000? What? I only asked for 800. I got them on the phone. Like, actually, it was sorry. It was like almost 9,000, 800 and 8,900. Anyway, they added a zero onto the balance and tried to transfer. And I said, on the phone, I said, "Hey guys, what's going on here?" I was only, and they said, "Oh wow, our mistake." I mean, really? Have you ever even heard of a bank throwing 10 times the amount of money at you that you asked to transfer? And gosh, gee whiz, it's just our mistake. I mean, I felt like it was the Monopoly game, bank error in your favor. And so I took that and I said, what am I supposed to do with this? I said, well, we can't reach into your bank because they had transferred, we can't reach into your bank and pull it back out. So what we will do is we will give you an interest-free 45-day grace period in order to put it back. On the other hand, if you want to use it, go right ahead. 18% interest, and so I thought, what a remarkable marketing ploy that should have been for the banks to all do that. But
Very good idea.
they genuinely had just made a once-in-a-lifetime mistake, and I was literally writing out the check to put it, to email it, or not email, to mail it back to them. And just as I was about to sign my signature, I thought to myself, wait a minute, what am I doing? Somebody just handed me $9,000 and said I can have it interest-free for 45 days, and I want to be a trader. So are these two things related? And of course, I did something ridiculously crazy. I went and talked to my wife about it. And even crazier, she did not say, no, foolish, give it back. I went to her with this plan and said, okay, how about this? $1,000, that's the limit. If we can't figure out a way to pay back $1,000, even if I'm unemployed, we have bigger problems. But that'll be my, drawdown limit. I'll take this $9,000. That'll be my trading capital. And if I lose 1,000, I stop. Over. Game over. Never coming back to it. On the other hand, if I make something after a month, let's talk. And she's like, fine, but you have to fill out resumes. You have to keep looking for work. I'm not going to have this deadbeat husband. I'm like, yeah, I got you. I'm right there. No worries. I wasn't worried at all. I had actually emailed out 200 resumes, not a peep back. I mean, that was just the way it was in the fall of 2001, for somebody with my skill set. So October, I really didn't know what I was doing. I tried Peter Lynch's so-called theory of buy what you know, and bought a couple of technology stocks that it was after 9/11. So I thought, well, this ought to be a good time because, Mark's going to read it.
Just a couple of months too early on that, I think, in October.
Now, as it turned out, it took me about a month, but there was a guy in my neighborhood, and I didn't even know he was in my neighborhood. In fact, I never met him personally, never saw his face. But somehow in my email groups that I was working with at the time, I really cannot remember how I got connected to this guy. His name was Larry. I never did get his last name that I can remember. But Larry was a NASDAQ market maker, former NASDAQ market maker. And he lived in the same town, the same suburb of Dallas that I lived in. And he and his wife were day traders for fun. They were retired, but they liked literally to sit there and day trade. They had birds. Every time I would call their house, I'd hear birds in the background. They just sit there, trade till the market's closed, feed their birds, go out and walk around the park, come back. That was their life. No. So needless to say, he was a little bored compared to, being a NASDAQ market maker professionally and massive stress and floor trading that was. And so he was just crazy to try and, give out some of his knowledge. And somehow, through email, whatever, he gave me his phone number, we connected, and he was willing to let me call him up for an hour every week and talk about whatever questions I had. And he was oddly recalcitrant about his information. That is to say, he was happy to tell me anything that I would ask him about, but he didn't want to overload me. So, if I didn't ask about it, he didn't talk about it.
Interesting.
It was fantastic as in terms of a learning procedure because it just literally gave me what I was ready for. And so we did that for just about 8 weeks, and that was an amazing start. In about 4 months period of time, I learned enough about trading. Well, so that was the second thing that happened. The third thing that happened was November 2001 was this fantastic month for NASDAQ stocks. In fact, it was the best single performance month in the 30-year history of the NASDAQ to that point. And so anything I was buying, and I was buying a lot. I was swing trading, and I was margin trading, I was just doing whatever. And most of the time I was winning. I just thought it was because I was smart. After 1 month, I made 50% on my $9,000 starting capital. I took the $9,000, I paid it back, and went forward with $4,000 and told my wife, I think I want to do this. I think I want to learn how to do this professionally if I can. And so she said, fine, as long as you can pay the rent. Well, or not the rent, the mortgage on the house we had at the time. I couldn't with just, $4,000 trading capital. So I went and got a part-time job teaching math at a local school. And I talked the administration into, they were a charter school, so they were really desperate for anybody that could teach math. And I said, all right, I'll teach, but I only work until 1 o'clock. I don't work the whole day, and I don't do lesson plans and, teacher coordination meetings. I just come in 4 hours, and then I go home. And that would give me 2 hours at the end of every market day to trade. And that worked out perfectly for me because I'd do my analysis and put my trades on, and I'd come back the next day, 24 hours later, see how it went. So it was a perfect swing trade timing, and it's actually a great model for how a Singapore person trades coming into the U.S. markets.
Mm.
Do a little analysis, put your positions on, and then come back the next day and see where it landed. Right, make your adjustments. And so anyway, I found it very, very productive for me to trade that way. And I didn't have 50% months in the next 2 years after that. So I learned the meaning of the saying, um, never confuse intelligence with a bull market, and um, realized that I had to do a lot more work to learn about things. So I was just a sponge for the next 2 years. And at one point, as I mentioned, I got into um, becoming a proprietary day trader with a firm out of Las Vegas, and they had an office in the town where I was living. So I would go in there every day, watch every tick of the market before it opened and after it closed. Did that for the better part of 2 years, and that was a real education. I did not make a lot of money. I didn't lose a lot of money. I mean, I lost some, but it was typical for what you would experience in a proprietary trading environment for your first year. But my third year, then I was trading on my own and just was doing a job that was back in my old field, but it had a 1 hour time frame that was lunchtime. And I had a door I could close, my own private office, and nobody bothered me. So for an hour, I would trade at lunch, and then I'd just go about the rest of my day. And that year, I made 80%. That was my third year, and 80%. And I followed it up the next year with another 80% return. And so I was pretty excited about that, and said, "All right, I've got a career trading, except I've got to find a way to not be in front of it all day long." I liken it to, if you stand in front of a food cart long enough, it smells good enough, and you buy it, no matter how bad that food is for you. And so,
There's a
like,
lot to be said for that, right?
yeah,
I think I've always said one of the interesting things. My wife has talked about this. She said, "I know when you're doing well because you're not here." She said, "When everything's going fine, I don't see you, and I don't see you because you're doing something else. Because once you've got those positions on, the best thing you can do is actually to walk away, because then time works its magic, right?"
that's a good way to be. I feel like the thing that I had to learn was I do better if I'm not looking at the markets all day, every day. And so I've got to have a systemic way of both doing that, but still, I mean, the thing that brought me to the markets was I just love learning about them.
Mm.
But how can I
Yeah.
continue to learn about them and yet not be trading all the time? So I looked for some opportunity to do that. And as it happened at that time, the company Invest Tools, which is in Utah. By then I moved from Dallas to Utah, was hiring coaches. And most of the coaches, a few of the coaches had a lot more experience than I did. Some were market makers from the options floor in Chicago, but others of them were just guys who had worked at Fidelity as order takers, customer service reps, and they didn't have nearly as much experience as I did, at least in terms of the prop trading every day, every tick kind of stuff. And so they were interested in having me come along, and that worked out really well for me because that particular employment position came with the idea, we want you to trade. Unlike most brokers, and Investors wasn't a broker or didn't have a broker part of them yet. They said we want you to be actively trading, and so I was so busy all the time I couldn't be trading all day. But what I was busy doing was talking with people and teaching them about the market. So it was this perfect scenario. Within 3 years, I became a head of the content for Invest Tools. So I was in charge of all the curriculum. And about that same time, they purchased TD Ameritrade, or purchased Thinkorswim. And about a year later, TD Ameritrade came along and purchased the whole bit. And TD Ameritrade had me in charge of the curriculum again, and made it all FINRA compliant. And there came this day in about 2010 where I had gone 3 months and I hadn't even looked at my trading account because I was just so busy with office stuff, bigger company stuff. And I said, this is not why I joined. This is not why I took this job. This is not the career. I need to be talking to people. I need to be working with them. I need to be teaching them so that I'm have this ability to watch the markets, but not trade myself into oblivion.
Hmm.
And so I made the bold step of going independent at that point and becoming a coach and consultant. And I've done a lot of things, but I've always kind of maintained that along the way ever since. And it's been fantastic. It was shortly after that that I actually met Ainsley and several others who taught me, all the students I've had over the years taught me something really important, and that is there isn't one right way to trade. I cannot count the number of times out of the hundreds of students that I've worked with one-on-one that I have had somebody come to me and say, I want to learn to trade like this. And I think to myself, no, you can't trade like that. That's ridiculous. That's a stupid idea. You're just going to burn up your money. Don't do that. After the first 3 times that I talked to a student and told them those things out loud, I learned to keep my mouth shut, because all 3 of those students within a month came and showed me how they were doing it profitably. I mean, using what I had taught them, but also using what they were interested in. I realized, there really isn't a one right way. What's really right is for you to do what you see in the markets and learn how to do it most efficiently.
Absolutely.
And so ever since I've concentrated on trying to teach people just the stuff that'll take their own ideas and make it the best it can be.
Is it possible to do all this from scratch, or do you think that a coach is a vital part of the teaching process?
Well, I had a coach. I mean, it was kind of an impromptu, weird sort of thing. It wasn't a coaching company that emailed or called me and said, "Hey, do you want this?" It was just a bored market maker who happened to be nice. However, it was such an effective mechanism that I really became sold on the idea. So that's why I went out and started doing that for other people. However, one of the things that I came across in trying to coach people was part of that dynamic. How do I help people not do things that are not well suited to them, and how do I get them to do things that are well suited to them? I was always looking for what method really works the best, and I'd find, here's a good method, and then I would share it with a bunch of other people, and some it would be good for, and others it would just be disastrous for. And I gave that same trade to 3 people, and they all had 3 different results. Why? So I went to try to find an explanation for that, so that in my coaching, I could make sure that I was really getting the right stuff to the right people. And I took, it was the year 2010, and I actually took 2 months to just dig into as much backtesting research as I could. And I started with the idea, I'm going to do the null hypothesis on technical analysis. Up until that point in my career, I was, oh no, yeah, technical analysis, it's predicted. Sure. I mean, patterns, they matter, and I thought, I'm going to prove that they matter by disproving the null hypothesis. I'm going to start off by trying to prove that the markets are totally random. And then when I fail and I can show, there, see how predictable they are? 2 months into it, I had not proven that technical analysis did not, or I had not disproven that markets were random, is a better way to say it. I thought, wow, this is terrible. I have actually been making money, but it looks like I've been doing it in random markets, and that there's no likelihood to change. How could I give any system to anybody and expect them to be able to trade profitably if the price movement is truly random? Until I came across one little anomaly that really shocked me. I was studying trailing stops. Now, without going into the detail, in the class that I taught with Actions 12 earlier this year, I dived deeper into it. But without getting into the fine points, basically I found that trailing stops have a mechanical edge built into it. All by themselves, they still can produce random results unless a couple of filters, right? But I saw this 3% edge. And I thought, why is that statistically there? It shouldn't be there if markets are random. So I dug in deeper on what does random price action really mean. I came across this principle called the arc-sine law. There's a Berkeley paper and a few others that talk about its formula and its application. And basically it says, hey, look, if things are really random and you put randomness in a data series, over time, that data will trend. So most people would try to say, most technical analysts would try to say the trend, the existence of trend proves that markets are not random. Otherwise, you wouldn't have a trend. You wouldn't be able to trade it. But what I found is that actually it's the opposite. A trend is a characteristic of randomness. So then it became my quest, how do I, using random expectations, take advantage of these trades, take advantage of trends that occur? And everything I've studied since then has helped me to identify edges that are still part of randomness, but just a nudge in one direction that has the potential to create a trend, even if randomness exists. Now, there's also herd mentality, which kind of pushes those trends on more than they would just by randomness. But if you can start with a random action, then you've got a bet worth taking, because either it's going to just go random, in which case you're going to manage it, get out of it, whatever you do, or it's going to be, a human augmented, and it's going to be fantastic. So it's low risk, high potential reward some of the time. So everything I've done since then focuses on finding those. And for me, it's super simple stuff. It's just a tall candle. If I have a bar that is more than 1.4 times the average true range over the past 3 weeks, that's my entry signal, my favorite entry signal. I wouldn't say it's my only. But I know that that is just as random as anything else. What I did find is that if I trade that and use a trailing stop, I have about a 3 to 5% edge in the markets. And if I'm frequent enough in my trading, that's all I need for the year to make a good year, is just a few of those results that come from trading in that way. And everything I look for now, whenever somebody comes to me and says, hey, I want to trade this, I look at their trading and I assume that they're going to face randomness. I say, all right, how can we get you a 3 to 5% edge? They're like, 3 to 5%? What are you talking about? I need 50% returns. I'm like, hey, stick with me here. That 3 to 5% is all you need. And the fact that it is so prevalent, if you understand how to kind of follow along the random style trends that come, it's all you need. But you got to trust it. I believe it. So let's start with what you got, and let's go from there. And it's like what you're saying. You get this sort of mentality that I believe this, so I'll try. So much of the time we say, oh, I don't believe that, so I don't try. And cryptocurrency, it's like anybody that has not traded in cryptocurrency, because I can't believe it's all funny money. It is funny money, but so is regular money. So it's all about belief. And you just have to sort of figure out how you're going to manage your risk in whatever you participate in. Well, those who said, I'll try that, they might be feeling super intelligent right now, but who knows where it goes from here, right? It's just, they did it because they were open-minded and willing to believe. Just because you believe something doesn't mean it's going to go great, especially in the U.S. stock market. 99.99% of all stocks under $5 a share end up at $0 a share within a year or 2 years or something like that. That's an actual statistic I researched at one point. However, something like better than 50% of them will gain 50 to 100% over any given 24-day period from a good entry signal. So if you know those important facts, it gives you a way to trust it and believe in it.
Yeah, look, and I say similar things because to the students, because I talk to them about, look, everything you do, let's start with the premise that it's a 50-50 bet, right? And everything you do adds percentages, right, to a trading edge, right? If you can find something that's vaguely profitable at 50-50, right? So it's got a 2-to-1 return, for instance, something like that. You're number one, you're going to make money in the medium term. Okay, there's the starting point, right? But how do you get better? How do you get better to the point where you can reduce the standard deviation of your losses and your consecutive losers? And this is all about improving the edge. So when I talk about seasonal patterns, I'm talking about cyclicality. I talk about price action. So what you're doing is adding a series of filters all the time, right? And you're saying, here, look, I
Right.
need you to filter,
Exactly
filter,
right.
filter, filter, filter. Right. All of those things may not add a lot, but I said you need to look at the maths and the movement from 55 to 65% success rate on trades if you can maintain your win rate. It's remarkable, and it changes over a period of time your equity curve in a way that is actually difficult to conceive. And I said, so when you
Mhm.
look at that and you go, well, there isn't a holy grail here. You know, some of the trades that I have like a 90% success rate. They work year in, year out, and that's brilliant. But there's only a few of those, and they tend to be associated with particular events and times of year, right? The rest of them are in the normal space, right? At the 50-60% success rate, something like that. But moving the dial a few points is remarkable about how that changes the equity curve. And also, there's another argument to say you can combine different trading systems. We probably don't have time for that. We'll discuss that another day as a potential way to improve things even further. But I'm really interested in the way you do that because it's a slightly different angle to the way that I look at it. But it's identical in terms of the approach and the thinking and convincing people that you don't have to be perfect, quite frankly, which is actually what this is about. And
That's right.
because in so many walks of life, you know, if you come, I always find the hardest people to coach are doctors because they have like a, you know, in their life they have like a zero failure rate, right? They've been through
That
it.
is literally true. I could go on and tell you stories. Of course, one of my favorite students was a doctor who was humble, and he was very good. It turned out to be a fantastic. But I had several others that were amazing crash and burn failures at trading. They were sought after doctors, had a very high net worth, large portfolio because they were successful. They wanted to learn how to trade it, knowing that they couldn't stay in that space forever. But they had been trained or had a feedback loop for 20 years from their customers and clients that they must be the expert, that they cannot be uncertain, that they have to know,
Yep.
and that this is the way things are. And when you approach the market like that, the market does not reward you.
Exactly, and it's one of the funniest things, as I've always said, one of the best professions to get into if you've been a trader, apart from being a psychologist, which I think always helps, is actually to be in the I used to call it the rag trade in London, but I think probably let's be slightly more polite and call it the American thing of being in the fashion industry, and and that area, right, is all about trading, right? You have a line of clothes. Your job is to sell your clothes, right? You've got to get the clothes out the door. The ones you don't
Yeah.
sell, you discount like crazy and get rid of. You understand what stop losses are. You understand when there's a trend going on to get all those more of those ones that are
Yeah.
selling best, right? I always think they have a natural inclination to understand it, which is interesting because so many of the traders who didn't have come from from if you like a college education background in the UK had often came from the East End, where they would come from the markets, right? Where they had this, if you're selling fruit, if you're selling clothes, you know how the world works, right? Intuitively,
It's sense
you
of time
absolutely
decay in
understand.
their
Oh,
decisions. Yeah.
100%. And you cut things really fast, and you know when things are going well, you just press that winner all the time. You keep on doubling up and doubling up. It makes life more interesting and more volatile, but actually it's amazing how remarkable when it's a great grounding, right? And I,
Myself and several of the guys that taught that were coaches at Invest Tools back in the day, we used to compare notes, and we found an interesting pattern that doctors were terrible traders, but nurses were fantastic traders.
oh, there's an
We would,
interesting point.
yeah, we what we found did it for them was their propensity and conditioning to follow procedure unquestioningly. And so we would give
Yes.
them certain procedures and say, in order to do trading well, you need to do all these and don't miss a beat. And they wouldn't because they're like, okay, I know how to follow rules. I
Oh,
can do that.
look, seriously, don't get me started on the men are from Venus, women are from Mars debate around traders. Again, we could talk for a long time about that, but summarizing that, you just have, and you've nailed it. And we'll just move on from there. Uh, uh,
Okay.
ladies, and if you're listening out there, please carry on doing what you're doing. I love coaching ladies. You learn very easily, and you listen, and you don't tweak anything. You don't come back and say, "Well, if I just did this, it would be doing that." They're often brilliant. They're lovely students, and it's remarkable. Successful traders, in terms of the winning balance of successful traders, always the women win out every single time. So
So I have to caveat that comment there, Julian, that it's true. I mean, your assumption is that by nurses, I'm referring to women. It's absolutely true that the majority of them were, but not all. There were plenty of male nurses that we coached that showed the same thing.
oh,
So yeah, I mean, it's true that women are often in professions or situations, or at least historically it was. I think it's less and less true nowadays. But where the job title was that they were expected to follow procedure, to be implementers, and that actually works really well for trading. But it doesn't matter what your gender is. If you can follow a procedure and check off boxes, you've got a leg up.
yeah, totally agree. Hey, look, I'm really conscious of time, and we're going to bounce over this, so I'll make sure I speak to Paul and we get a little bit of an extra few minutes. So, the markets today. Give me a view about where we sit. I know that you have some firm views about about cycles and the timing, and we're hitting
Yeah.
that cycle period now that you've talked about. Perhaps you could just elaborate on that for me.
Yeah, let's see if I can do this really quick. There's a recording from about 3.5 weeks ago or so where in my charts and chats with Gordon Scott CMT on the Actions to Wealth YouTube channel, where I covered everything there is about the 56-week pattern. Now, the 56-week pattern is a seasonality approach that isn't tied to a given calendar month, but is tied to a market action. It's the idea that if enough money comes into the market at some point, there are a variety of reasons why it will want to go out at a particular time.
Mm.
What I found in studying U.S. stocks is that the sweet spot for that timing is 56 weeks. So when you have a major market low and the market rebounds rapidly off of that major market low, then 56 weeks from the period of 20 days away from the low turns out to be a period of high risk for falling prices. Well, COVID happened. The bottom in the S&P 500 was somewhere in mid-April, or it was mid-March rather, and a month later was mid-April, and so you start the clock ticking then, and what you get to is mid-May. So I've been telling everybody for the past several weeks, May 14th is doomsday, and there's going to be a lot of selling. Now, like any cyclical study, it's never certain. You don't get the exact same movement every time. And what you have are conditions. And these conditions create a moment where if something else happens to come along, then people are more dispositioned to sell or buy, depending on what you're looking at, than they would be at other times. So between now and May 14th, I think today's drop in the market was absolutely a clear indicator that people are of the mindset. I read somewhere on one of my LinkedIn connections feeds that China had made a flyby into Taiwan airspace, and that all of a sudden the S&P futures dropped in the overnight session dramatically during that period of time. I couldn't find that headline anywhere in the regular feeds, so I don't know if in fact that was his speculation or if that was a misinterpretation. But it makes a great example. Whatever it was that made the S&P 500 drop, it spooked somebody. Well, a couple of months ago, or 3 months ago, January, coming right out of 2020, where we had this great year. January was a fantastic month for stocks. There wasn't really a lot of people were still riding the GameStop wave and how exciting, I can make a whole bunch of money. There was money flooding into the markets, and bad news like that came along and people just bought the dips. So if you change the script somehow and you say, here's a bunch of people that all want to sell. Why do they want to sell? They have a collection of reasons, but the biggest one is that institutional guys, they have their algorithm that they need to hold for a year, tax and other things that make them say 1 year, I will not sell. I cannot even consider selling my position until I've held it for 366 days. And that alone applies to such a large pile of money in the markets that when you get people that just happen to get in at the month close to the COVID low, now saying, I'm sitting on 60% gains here. I've had a great year. I am not going to lose this year. And if I have to give up 10 or 15 or 20% of that, that's not going to hurt my career. I'm still going to get a bonus because I can say I made 40% in the past trailing 12 months, right? So when they come to the point where they say, I've got to sell, they're going to be a little bit more aggressive about selling. They're not going to worry about slippage as much because they're sitting on a huge chunk, right? So
Absolutely.
that's the sort of 56-week patterns, psychological underpinnings, at least in the, I think, the core demographic that drives it. And May 14th is the period of time which statistically over time appears to be the most vulnerable moment. If in fact bad headlines occur during that period of time, and we see markets slide quite a bit, that can change attitudes from people all over the place. Say, oh, if the market's going down, I'm not going to get in anymore. I'm not going to buy this dip, right? And who knows how long that selling can go. So every week I'm trying to update people on, well, here's what it'll look like when we come out of it, about a 4 to 8 week, downward washout, and then we watch to see what kind of rebounds tend to come. There's a lot of U.S. money getting created. There's a lot of foreign money that wants to invest in U.S. stocks. So it could easily rebound from whatever low that it makes. And if it does, that would be a fantastic buying opportunity.
Yeah.
But it's already shaping up that there is going to be significant selling pressure over the next 2 to 3 weeks, probably for the entire month of May.
Yeah, and look, I think I'll just support that by, much as I love and hate Jim Cramer at the same time. He made a very interesting comment the other day when he just said, this market trades heavy. It trades like there's lots of supply out there, which there has been over the course of the last 6 months to supply the unbelievable amount of inflows into this market that have taken place over the course of the last 18 months, right? Which have been, find a standard deviation, because there isn't one that applies to the last 18 months versus the previous almost 10, 12, 15 years, right? And I think, you always worry from a sentiment cycle basis. I often look at things from a sentiment cycle and you go, well, okay, here we are. Is this the point at which the last guys are now getting long, right? And you're going, okay, this is a bull market that's been, last year, which I guess you could argue was a buy the dip moment, right? Has been going on now for the course of the last 10 years in an unbelievable way. Are we due for something? And for me, the sentiment is beginning to shift, and I detected it, not always when you listen to CNBC, because they're remarkably positive people, as is their job, right? But the people, the talking heads who I respect, are saying to me that they're seeing this supply coming through, and going, well, that's the first time when anybody's ever talked about it getting tired, right? And so then it feels, my way of thinking matches in with what you're saying. I have a cyclical measure that I use as well too in the US stocks, and that peaked in early April. And that's a multi-week, multi-month signal. And there's, and I believe some of the Tom DeMark sequential stuff all hit last week, right, on the weeklies.
Yes.
As well too.
The nines. Yeah.
Yeah, I follow Tommy Thornton, and he's a brilliant analyst around that, and he came up with a couple of those target dates as well too, and also that's hit the European markets too. So everything is coinciding. So hence the reason why I'm with you 100%, and maybe we're going to see some really interesting price action over the course of the next few weeks. Which, by the way, guys, we're traders. We can take advantage of the downs as well as the ups, and that's going to have feedback loops for foreign exchange and have feedback loops for other asset markets, for the precious metals. They've been on a tear recently, not just gold, but silver's been doing really well, and also platinum. And then you think about the raw commodities, they've all gone vertical. The grains, remarkably, and I still don't quite understand why grain markets can ever go vertical, but they've gone vertical as well too. And so you have this overthing, and I think there'll be a wave, right? And maybe some of this, it'll probably start in the stock market and then maybe feed. So people need to be aware. They need to be on watch, right? But this is great, because this is what we do as traders, and our job is not necessarily to analyze it and go, great, I got the analysis right, but to try and make some money out of that. Gordon, I'm really conscious we're going to bounce time here. I could do this, and we could be sat here for 2 hours, and I think we'd still be going, right? We'd be really enthusiastic. So,
Indeed.
Thank you very much for spending some time with us. Are you ready for some rapid fire questions?
I am ready.
Okay, so these are questions I ask everybody at the end of the session, just as just for a little bit of humour, but also a little bit of perception as well too. So, start with what trader has most influenced your trading?
Probably Van Tharp.
Oh,
He's more of a psychology coach than he is a trader, but I started studying his books and reading just everything he had. In fact, actually, after a long period of time, I think it was in 2011 or so, I got the chance to partner with his organization and work with him, and I've had a very friendly relationship with he and his staff for years since then. But they do a fantastic job of teaching people deep psychology changes, and I learned from them that I don't like deep psychology changes. But the math behind everything that they did with position sizing and those sorts of ideas really set me up um, to learn better. And they had one person on staff years ago, a man by the name of Chuck LeBeau, who I think is still today probably the most expert voice I've ever heard on the subject of exits. And I learned so much from him, and actually ended up developing a little bit of a uh, I've never met him in person, but I've had many phone conversations with him. Very interesting career and stories from him. But his learning and his experience that he shared with me has greatly shaped my trading and how I coach other people.
very interesting. And I would encourage all of our listeners and viewers, if you're seeing this on YouTube, to actually look at some of the Van Tharp material. It is awesome. I haven't had the pleasure of meeting him, but I have a huge respect for him and the organisation. They have done so much for people understanding risk management. Actually, which interestingly was kicked off. When I first started trading, nobody had heard of risk management. Right, there were very few people who were even talking about it in the 90s. Nobody cared. Right, and I remember Larry Williams in those days was beginning to talk, and he worked with a couple of guys who were talking about how you manage the account using maybe starting with a Kelly formula, which was utterly nuts, and he knew it was nuts and was trying to control it and trying to figure out how that stuff works. But I think Van Tharp came along afterwards and put some real meat on some of those discussions, which
Yeah.
has been tremendous benefit for everybody. If there's anybody who should be in a Hall of Fame for trading, it should be him. So, favorite indicator in trading?
Keltner channels would have to be it. I look at the Keltner channels in so many different ways, so many different times. Over the years, I've enjoyed looking at all kinds of technical indicators, but the one I keep coming back to are Keltner channels. I don't use them in a way that I think would be what people expect, because I did some backtesting research, and what I was expecting to do was to find some way to trade them, kind of like the way you intuitively think about Bollinger Bands. It hits the side, play the reversion to the mean. I was looking for a reversion to the mean system and some indicator that would help you get an edge, a 3 to 5% edge on a reversion signal. And I thought, well, Keltner channels are based on average true range, so that's, it's not funny statistics. It's not standard deviation, which depending on how you calculate it, and it's not volatility, which has a hard time translating from, its index to the actual markets, and let alone an individual stock. It's that is implied volatility. It's just the price move, and the price move is going to be the same for whatever security you're looking at. It's just numbers. So why wouldn't the Keltner channels work, right? So I did all that back testing, and what I got was there was a 3 to 5% edge, but it was for breaking out of the channels, not for reverting. And it just stunned me, but I don't know why I should have been surprised by that, because it totally fits with the arcsine law and the idea of a continuation of a random trend. So it's like when you get out to the third or fourth band of the Keltner channels, that's using Keltner channels are a multiple of ATR, right? So I put them on 1, 2, 3, and 4 kind of thing, so I can see this sort of lanes in a river, so to speak.
Yep.
And when I get to either bank, I know here's a trend that could continue. At least it has a 3 to 5% edge that it will continue. If I'm trading the early touches of it. If it's down there and staying for more than 10 to 12 days, then there's no edge. But the first few touches, the first 5 days after the first touch, there's an edge, and it just was amazing. But ever since then, it's just one of those indicators I believe in now.
Oh, cool. Okay. What's one attribute that a trader should have?
One.
Just one.
I mean, the first one that comes to mind is one that I can't say in isolation because it's very misleading to say in isolation. So I think the one that a trader has to have is the ability to forget yesterday.
I like that. I really like that. Yeah, let it go.
Yeah,
Brilliant.
good or bad. You cannot say, I know what I'm doing. Oh, I had a great day yesterday, or I had a great day the past 12 weeks. Every day is a new day.
Brilliant. Joe Biden, savior or caretaker?
Um,
Bear in mind I'm asking an American this, right? So I haven't asked an American this question before. Everybody's had an opinion, but not the actual
yeah,
people that
yeah,
live in the country.
yeah. I think Joe Biden's behavior and record, if you actually research it, speaks for itself.
Good answer. I like that. And yes. Uh, okay. Crystal ball time. Uh, uh, Back to, we're going to go look at funny money for a second. What price level for Bitcoin in a year's time?
Good question. Very good question. The fact that Ethereum has broken, 2,500 and is up in the 3,000s, I think is a very strong bit of evidence, particularly in the market circumstances we're in right now. Very strong bit of evidence that it is going to go higher before it goes, well, I don't know, higher before lower, but there are much more upside chances than downside for Bitcoin. So on the low end, I would, if I thought it was going lower, I would think it was going to be in the 40s by the end of the year. If I thought it was going to higher, it would be in the 70s by the end of the year. And between the two, I think crypto still will go higher. So I'm going to say in the 70s by the end of the year.
Cool. Cool. Okay. And that's actually in the pack, by the way, for the answers that I've had. So there have been a couple of standard deviation answers that are quite impressive. You can clearly tell where people's wallets are positioned. So in a speed eating food contest, what food would you choose?
Well, I would choose Mexican food. I shouldn't, but I would.
I think you're
For speed eating, I was like that. That's just, couldn't pick much of a worse one. But I just, given a chance, I tend to drift towards Mexican food
And
for
folks,
any reason.
and again, folks, if you're listening to this, one of the key traits of a trader is to be very brave. And somebody who can speed eat Mexican food certainly hits the brave camp for me. Gordon, you've been amazing. Thank you very much for your time. And we could talk and we could rap forever. Hopefully, we can get you back on the show at some point in time, and we can get into details about some of the areas that you're also really passionate about there. And I'd love to explore them more. Look, thank you very much for your time, and to everybody out there, as always, if you have been, thank you for listening. Thank you, Gordon.
Thank you.